The minute that COVID hit, the correct policy response was for the government to cut spending because the economy was contracting, people weren't working, and they weren't producing goods and services. But the government did the opposite of what they should have done. The government said, hey, we have to make sure that people who are no longer working keep spending money. Why? They're not earning money. How can they spend? They're not producing anything. But we sent everybody home and said, don't produce stuff. And here's more money. And you can now go out and buy even more stuff now, unemployed, when you're not working, than you used to buy when you actually contributed to the production of goods and services. So we simultaneously reduced the production of goods and services, and we gave people a lot more money to go into the market and buy the goods and services that we weren't even producing. But what's driving the price is the fact that we did the wrong thing. We should have encouraged people not to spend because they weren't working. We needed people to spend less, but instead they spent more. But on what? We weren't making the stuff, so the prices are going up. And now, if you look at the imports, we have record imports. We are importing more than we've ever imported before. The volume is a record, right? Not only are the deficits a record, but the imports are a record. So we've got more supply coming in from the rest of the world than we've ever had in the past. The problem is we've got too much money to spend it on. And Americans are not producing because we're more reliant on foreigners. Because to say, hey, it's about COVID, that's why we're not producing. Well, why is China producing? Why is the rest of the world producing? Because they have record exports. China has the largest trade surpluses in history because it's making all this stuff and sending it to America. I mean, they have COVID over there in China too, yet how come they produce all this stuff and we don't? The problem is we have a more reckless monetary policy and a much weaker economy fundamentally, because we're not producing. We're just producing money, right? But when the Federal Reserve prints money and gives it to people to spend, that doesn't mean there's more stuff to buy. So if you got more money to buy the stuff, well, the price of the stuff has to go up. That's basic supply and demand. That's what inflation is. It's an expansion of the money supply. Rising prices are just a consequence of inflation. So all this talk about the government trying to scapegoat supply bottlenecks or the economy reopening and ignoring the elephant in the room, which is massive money printing by the Federal Reserve to finance huge deficits by the federal government. That's it. I mean, first of all, we know what's going on with rent, right? With owner's equivalent rent, which the government uses in replace of actual rent. And actual rents are rising 4 times faster than what, owner's equivalent rent. And of course, home prices don't even make it into the CPI at all. And they're way up. So people who want to buy houses, they're looking at even bigger price increases than the people who want to rent them. But I think a lot of the other, numbers are massaged the way they are, put through the methodology for computing the number. They substitute things. If things go up, they don't count them. The whole system is rigged to give you a low number. And despite the rigging, we still have almost 7%. If you annualize the first 10 months of this year, and then, it's almost 7% inflation measured by the CPI. So, even the government number is bad, but reality is much worse. Well, I've been taking the over on CPI every month. I mean, I generally think that's the safer bet. The markets are usually disappointed when the number comes in higher than expected. The only thing that's interesting now, and this is recent because it happened again this month, is we got a hotter than expected inflation number and the price of gold went up. It was up about $18 yesterday. It's up another $10 today. And, that's what you would expect, right? You would expect gold to go up on high inflation. But what had been happening is that we'd get higher than expected inflation numbers and gold would sell off, sometimes, $20, $30. And the reason for that is the market is still foolish enough to believe that these higher inflation numbers mean the Fed is going to have to react to put out the fire. The Fed is going to have to get tough on inflation. It's going to fight inflation with more aggressive tapering or rate hikes. And so gold always factors that in and sells off because the markets start looking forward to this tighter policy. What the markets still don't get is A, the Fed's probably not going to try to fight inflation. And B, even if it does, it's going to lose because it will not be able to raise rates enough in order to make a difference. If inflation is 7-8% by the time the Fed gets around to the first rate hike, how is it going to do anything? If the Fed goes from 0 to 25 basis points, 0.5%, even if they go up to 1%, what difference does that make when inflation is 8%? You are so far behind the curve that there's nothing you can do. The Fed would have to jump out in front of the curve. So if inflation is 8%, the first rate hike has to be like to 10%. You got to get out in front of that curve to bend it. But of course, that's never going to happen. We're not going to get any real rate hikes. They had to stop the rate hikes in 2018 at 2.5% because everything started to collapse. Well, if we collapse to 2.5% in 2018, we're not going to get anywhere near that high now because we have so much more debt today than we had back then, thanks to all the stimulus that has occurred since that point in time. This decade is going to be a big inflationary decade. It's going to get worse. It's going to be much worse than the 70s. I just don't see a way out, really. We got out of it with Paul Volcker and Ronald Reagan in 1980. I don't see a Reagan on the horizon in the White House. We're not going to get another Paul Volcker. And even if we had Paul Volcker, how could they raise rates? In 1980, when the Fed raised rates, it only impacted the new budget deficits. It didn't impact the national debt because the national debt was financed with 30-year Treasury bonds. Today, the national debt is financed with T-bills. We got almost a $30 trillion national debt. If they had to jack interest rates up, let's say even at 10%, we would pretty much have to refinance the whole national debt in 3 years at 10%. Right now, we got it financed at, like 1%, 2%. Really low. What would happen to the economy? It would implode. Think about the real estate market, the stock market. Everything would collapse. So the deficits would skyrocket. And of course, how would they pay the interest? So we're in a position where we can't raise rates. In 1980, America still had trade surpluses. Now we have huge record trade deficits. In 1980, America was the world's biggest creditor nation. Now we're the world's biggest debtor nation. There's no way we can survive the cure for inflation. The cure for inflation would kill the economy, which is why we're not going to get it, which is why inflation is here to stay, and it's going to keep getting worse. And all the people can do, or the powers that be, is rationalize it, kind of dismiss it. It's transitory. And eventually, when they can't claim it's transitory anymore, they'll say it's a good thing. It's a sign of our prosperity. It's just a price we have to pay for a strong, growing economy. They're going to keep on saying all that until eventually they're going to go with the price controls.